Welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies and study exactly how they think. Today we're looking at an expert advisor for MetaTrader 5 called Momentum Diffusion Trend Shift. It borrows an idea from market breadth analysis, the diffusion index, and applies it to a single price series to measure how widely a directional bias is spread across recent bars. By the end of this video, you'll understand what the diffusion index is, how the strategy decides to go long or short, how it manages its exits, and how the whole thing reads inside the code. Remember, this is educational content only, not financial advice. Let's get into it. Let's start with the big picture. Momentum Diffusion Trend Shift is a trend-following strategy that trades a single symbol on a single time frame. What makes it interesting is the indicator at its core. Instead of reading one momentum value from the latest bar, it pulls a whole window of recent bars and asks each of them the same simple question. For each bar, it measures the momentum over a short look back, comparing that bar's close to the close a few bars earlier, and it records a single yes or no vote. If that momentum is positive, the bar votes up. If it's negative, the bar votes down. The strategy then counts the up votes against the down votes across the whole window and normalizes the result into a single number that runs from -1 to +1. This is the diffusion index. A reading near +1 means almost every recent bar is riding an uptrend, so directional participation is broad and mature. A reading near -1 is the mirror image, a broadly bearish tape. A reading near 0 means up and down momentum are canceling out, a balanced or choppy market where there's no clear consensus. By default, the strategy looks at a window of 20 bars, each voting on 3-bar momentum, and then smooths the raw index with a short exponential moving average so that single-bar noise doesn't whip it around. The smooth value is what the strategy actually watches. This approach is designed for traders who like the logic of trend following but want stronger confirmation before committing. Rather than reacting to one bar that pokes in a direction, it waits until a broad share of the recent window agrees. It's a patient, participation-based idea. As always, trading carries real risk, losses do happen, and nothing here is a promise of any particular outcome. This breakdown is purely to help you understand how the mechanics work. Now let's walk through the exact decision process, step by step. On each newly completed bar, the strategy rebuilds its diffusion index. It counts how many of the last 20 bars have positive short-term momentum versus negative, and it turns that into the sign breadth reading between -1 and +1. It then applies a short exponential moving average to smooth that reading. For a long entry, two conditions must both be true. First, the smooth diffusion index must freshly cross up through the positive signal threshold, which sits at 0.30 by default. Fresh is the key word here. The strategy checks that on the previous bar the value was at or below the threshold, and on this bar it's above it. That crossing means bullish participation has just become broad. Second, the current close must be above the baseline exponential moving average, which by default uses a period of 50. That baseline acts as a regime filter, keeping long entries aligned with the larger uptrend rather than fighting it. A short entry is the exact symmetric mirror. The smooth diffusion index must freshly cross down through the negative threshold at -0.30, and the close must be below the baseline-EMA. The behavior on both sides is identical, just flipped. Once an entry is confirmed, the strategy sets its protective levels using the average true range. The stop loss is placed a multiple of ATR away from entry, 2 times ATR by default. The take profit is then set at a reward-to-risk multiple of that stop distance, 1.6 by default, meaning the target is 1.6 times as far away as the stop. Before entering, the strategy also checks that the spread isn't wider than the allowed maximum, so it avoids poor fills. Finally, exits. A position can close in 3 ways. It can hit its ATR stop loss, it can reach its reward-to-risk take profit, or it can close early on a breadth flip. That flip happens when the smooth diffusion index makes a fresh crossing in the opposite direction, signaling that participation has reversed. Only one position is held at a time, so the strategy always manages a single clean trade. Let's read through the code as it appears in Meta Editor. At the top are the inputs that shape everything. Diffusion window is 20, the number of recent bars whose momentum votes are polled. Momentum lookback is 3, the horizon each vote measures. Signal threshold is 0.30, the breadth level the smoothed index must cross. Smooth period is 3, the smoothing on the raw index. Baseline EMA is 50, the regime filter. And AtrStopMult and RewardRisk at 2.0 and 1.6 control the protective distances. Next come the two crossing checks. Cross-up is true only when the previous smooth value was at or below the positive threshold and the current value is above it. Cross-down is the mirror, testing a fresh move below the negative threshold. Then the regime gate reads the baseline EMA and the last close and combines them. Go long requires a fresh upward crossing with the close above the baseline. Go short requires a fresh downward crossing with the close below it. Look at the buy block. When go long is true, entry is taken at the ask, the stop is placed the ATR stop distance below entry, and the take profit is set the reward to risk multiple of that distance above entry before calling trade.buy. The sell block is the exact opposite. Entry is the bid, the stop sits above entry, the take profit sits below at the same reward to risk multiple, and it calls trade.sell. Both sides share one clean structure. Let's walk through this illustration candle by candle and watch how the diffusion index in the lower panel drives everything. The gold line is the smooth diffusion index, running from -1 at the bottom to +1 at the top. The green dash level is the long threshold at +0.30. The red dash level is the short threshold at -0.30, and the gray line is the zero midline. Up on the price chart, the blue line is the baseline exponential moving average that acts as our regime filter. Look at the first two candles. Price is drifting sideways, and the diffusion index is sitting close to the midline, barely above zero. That's a balanced tape. Up votes and down votes are roughly canceling out, so there's no broad consensus and the strategy stays flat. It's waiting, not guessing. Now watch the third candle. Price pushes higher and closes above the baseline moving average, and in the panel below the diffusion index climbs and freshly crosses up through the green long threshold at +0.30. That's the exact condition the strategy needs. Bullish participation has just become broad, because a wide share of recent bars now carry positive momentum, and the close is above the baseline. Both conditions line up, so the buy entry marker appears. The stop loss is placed a couple of ATRs below entry, and the take profit is set at 1.6 times that stop distance above, respecting the reward to risk setting. Over the next two candles, the move follows through cleanly. The fourth and fifth candles print strong bullish bodies. The diffusion index rises deeper into bullish territory near +0.8, confirming that participation is widening rather than fading. On the sixth candle, price tags the take profit target, and the long trade closes for a win in this illustration. Notice how the broad breadth reading gave the move room to develop instead of reacting to a single bar. After that, the tape rolls over. The seventh candle stalls near the highs, and the eighth candle turns down and closes back below the baseline moving average. In the panel, the diffusion index falls sharply, and it freshly crosses down through the red short threshold at -0.30. Now the mirror conditions are met. Bearish participation has become broad, and the close is below the baseline. The sell entry marker appears, with the stop placed above entry and the take profit set the same 1.6 reward to risk multiple below. From there, the 9th, 10th, and 11th candles slide lower in a steady sequence of bearish bodies, and the diffusion index deepens toward -0.8, showing the downside consensus holding. On the 11th candle, price reaches the short take profit target, and that trade closes as well. Remember, on top of these targets, a fresh opposite crossing of the index would have closed either position early as a breadth flip. So the strategy is always ready to step aside when participation reverses. That's the complete cycle, a long and a short, each demanding broad, distributed momentum before committing. So that's momentum diffusion trend shift from start to finish. We looked at how it builds a diffusion index from many overlapping momentum votes, how it waits for that smooth breadth reading to freshly cross a symmetric threshold, how the baseline moving average keeps entries aligned with the wider regime, and how it manages risk with an ATR stop, a reward to risk target, and an early breadth flip exit. The goal throughout is to demand broad participation before committing rather than chasing a single bar. Everything here is educational information only and not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses are a normal part of it. If you found this breakdown useful, please like the video, leave a comment with the strategy you'd like us to study next, and subscribe so you don't miss future analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.